A couple things. So first, just kind of an update on your group projects and the final exam. So next Monday and Wednesday, per the original syllabus at the beginning of the semester, you'll be delivering your final group presentation, which is a significant portion of your grade, on one of those 2 days. As said at the beginning of the semester, those are both mandatory attendance days for both days, regardless of whether you're presenting or not, just out of courtesy to everybody else. If you can't be here, need something written and substantial as an excuse. Right? So otherwise, we should expect a full house for both of those days. Those presentations are going to be 15 minutes versus 10 minutes. So a couple of differences which you need to be working on this week. Number one, they'll include Q&A. So I have the right to question you about anything as part of your presentation. And I'll probably be interrupting you mid-presentation with questions. The questions will be part of the grade. Number two, you need to update the presentations with the most recent data. So you should be refreshing this week with current data, current buy, sell, hold, current as is, current multiples, etc. So all the data should be refreshed and current as of at least this week. You'll submit a new complete PowerPoint file by Monday at 10 a.m. for all sections, whether you're presenting on Monday or Wednesday. And the presentations will build on your previous presentation. So you need all of the data as a baseline. And you have to give the exact same data in the PowerPoint plus more. And I've already listened to those presentations, so you have to cover everything again, but you'll have to cover more than what you've covered before. And you have flexibility to decide where you want to spend more time on what's most relevant to your buy, sell, hold opinion and target price. So if there's one section that's more important than others, you can spend more time in that section, less time on other sections, so you don't just have to repeat everything again. Okay? And most importantly, you have to give additional context, particularly in the EIC section. And I'm going to give you an example today using a banking industry example of what I mean by giving more context than the numbers. So you can't just say in next week's presentation that I think that the industry is getting better or worse. You got to give a why. And you can't just say my company has competitive advantage. You got to give a why. You got to still give the numbers, but you got to give much more context, and you have to know a whole lot more about the companies than you have historically. So one thing you need to be doing, if you haven't already, is leveraging the BI section of Bloomberg, which is business intelligence. And again, you should have learned about this in your certification, but it has a lot of industry data that will tell you a lot more about what's going on in your industry. And you need to be talking about that as you go through your presentation for whichever industry you happen to be presenting on. So, again, today's class, we're going to go through banks, and I'm going to give you more of an example of what I mean by giving more context than just saying that banks are actually a tough industry. Okay? Because again, I know you know how to do the math. I know you presented the math, but I want more than just the math. I want your rationale, your thinking behind the math, as well as the math. So if you were a banker and I was the customer and you were explaining the actual buy, sell, hold and trying to convince me, that's really what I want you to be doing next week. Tell me what's important, tell me why you think what you think, as well as providing me the data to support that. So, following Monday is supposed to be our final class. I think that's what, Monday, December 12th? Does that sound right? So here's the deal. I have a deal for you guys. We're not going to have class on Monday, September 12th, right? Because it's basically going to be the introduction to the final exam, and the final exam is going to be a take-home final exam. So you'll take it on ELMS, and you'll have 7 days to do it, starting Monday the 12th and ending Monday the 19th. Now, it'll be on a timer. So when you start the exam, it will start a 4-hour timer, so you must finish the exam within 4 hours, but you can take it anytime during that 7-day period of time. It'll be a 1-part exam. It won't be a 2-part exam, so everything will be together. I don't expect it should take you more than about an hour and a half. I always underestimate, but nonetheless, you'll have up to 4 hours to take it during a 1-week period of time. So in lieu of having a regularly scheduled exam, it'll be online. And rather than just showing up for the final class, so I can basically say, here's the link, I figure you can get that online, and we'll skip the final class. So our final class will be next Wednesday. All right? And so we'll finish up the presentations, and then we'll talk about the exam, close out the semester. right? In return, I'm about to start getting emails, and you are too, about filling out the online survey for this class. So what I'm going to ask in return, because otherwise the other thing I'll have to do on that Monday is harass you to do those online evaluations. So just do the online evaluation. So if you do the online evaluation, we will skip the final class and make that essentially the take-home final exam. Right? Questions about that? Sound fair? Right. We'll talk more about the exam, obviously, next week after the presentations, but pretty much it'll be a lot like the midterm part 2, is what I would say, plus some math. But it won't require Bloomberg. It won't require any data. If there is any data you need to analyze or calculate, I will give it to you within the context of the exam, because you'll be taking it at home and you won't have access to the terminals in the classroom. And you can take it online anywhere, but it's an individual exam. Yes?
Could you share like something like a rough like study guide for us to review?
We will talk about it next Monday, but the short answer is kind of hard to do because everything we do is kind of based on the concepts we're using the semester. So it's really around testing you, like in midterm part B, on the core concepts of the semester, right? So, and again, it's open book, open notes. So it's also, I think, harder to study for an open note exam, but nonetheless, it'll be an open book, open note exam. And you will need Excel. Yeah. In this class, it's hard not to be cumulative because, for example, today we're going to be using the key value driver formula. So we would have to understand that in this class. So in a way, this class by definition is cumulative. Yep. All right. So today, as I said, what I want to do is to help you prepare for your presentations next week. If you remember on the syllabus, and if you looked in the homework section, there was 30 points of homework. We've only done 27 points, and there's 3 points left. Right? That 3-point assignment is going to be due Wednesday, as in 2 days from now, 10 a.m. And it's going to be based on what we cover in class in the next 30 to 40 minutes. So we're going to go through what you need to do in the homework assignment. I'll make the homework assignment available today at 4:30 just because I don't want the later sections doing it during class. But otherwise, it'll be available today. It will require Bloomberg, and it's due Wednesday at 10 a.m., and we'll talk about it Wednesday. But it's kind of practice to help you get more insight into that EIC plus section that we're going to be doing on your group projects. And then between Wednesday and Monday, just time to work on refining the group projects. Right? Questions? Okay, so let's go ahead and jump right in. So if I go to the PowerPoint, Lecture 7. So this is a presentation I've actually presented in the real world. These slides are based on a McKinsey survey of the global banking industry in 2015. And what they did is they tried to understand performance over time in banks and what explains that. So the first slide is, and this is just a difference in this class versus versus why we didn't talk about banks, right? Because banks are kind of special animals, and most of what we've been doing this semester is talking about non-banks, think manufacturing service companies, right? And here's the reason why, right? If I value a company like, pick one, IBM or Google or, I don't know, Estee Lauder, then anything that Estee Lauder borrows in terms of debt is financing cost. And when we do our Modigliani-Miller, it's pretty clear that that's debt. And one of the things about ROIC as a metric is I want to separate out operating from financial performance because it gives me a better sense of how the firm is actually performing. When I get to banks and financial services firms, it becomes tricky. And a few years ago, I was working with Morgan Stanley on this, and they were actually trying to estimate a WACC internally at Morgan Stanley, and they got quickly bogged down. Because if you get a loan from a bank, then they are using debt to finance that loan. So the bank makes a net interest margin, and the interest expense the bank is paying on the money they're borrowing to lend to you is a cost of goods sold, right? Versus some of the debt the bank borrows is to fund the long-term capital requirements of the bank. So what ends up happening is that for debt at a traditional company, manufacturing or service, it's financing. For debt at a bank, it could be operating, it could be financing, and it's often left to discretion because that's what Morgan Stanley started getting into. They started getting into transfer pricing, and more importantly, they were starting to have to prioritize, okay, this debt is for loans and that debt is for this, and it was kind of an arbitrary decision they were making to allocate the debt. And then it became really hard to justify what was really the WACC because it was really based on the choices, and a different bank could make different choices. So it was hard to standardize even across banks, which is why banks generally don't use a WACC for evaluation because it's too hard to calculate. And so that's why they don't use ROIC, because ROIC is the return on the debt and equity, which is based on the WACC. So what we do is we use cost of equity against return on equity. So instead of ROIC, it's the return on equity. Instead of the NOPLAT, it's the net income on the equity, and therefore it's the cost of that equity. And so it's still spread, but it's spread based on ROE. And instead of doing a DCF, discounted cash flow, to all cash holders, you actually do a DCF to just the equity cash flows and value that on a per share basis. So you kind of leave the debt in. So again, that's why we're not really doing bank valuation, but the principles are identical that we've been talking about this semester. So I'm just going to apply it here to the banking industry. So long story short, the average cost of equity for global banks between 2000 and 2014 was around 10 to 12%. All right, that's typical for most banks. Somewhere around, in this case, 9.5 to 11, but generally around 10 to 12 long term is what banks are expected to earn. And in this case, it was around 9.5 during this period of time, lower interest rate environment. All right, but here's the point. McKinsey showed that pre-crisis, before 2008, banks were doing really well, and post-crisis, banks were doing really poorly. But what they also said is why. And one of the things that changed about the banks was net interest margins went down dramatically because interest rates plummeted. And banks have to make money on the spread of interest rates, and if interest rates are low, they're just not making a spread on those interest rates anymore. And that's one of the reasons why bank profitability was lower. So when we talk about essentially the power of the buyers and the impact on the industry and the rivalry, and the reason why interest rates are lower and the banks aren't making money, part of it is because we're in a low interest environment long term. And if that doesn't change, then when I think about future 5 forces for the banking industry coming out, not much is going to change if the interest rate environment doesn't change. So what is the interest rate environment is going to be key to a bank. The other thing that happened with banks during this period of time is they make money on the yield curve because they basically borrow short term and they lend long term. Well, the yield curve has been relatively flat. Okay, until recently, the yield on the 10-year treasuries was 1.5 to 1.7%, and the yield on short term was close to 0, but that's a relatively flat yield curve. So it's not like banks were getting giant spreads on their loans. So the shape of the yield curve is also very important to what happens to banks. And is that going to change over time? Now, actually, in the last 2 weeks, post-Trump election, the yield curve has actually spiked up on the long end. It's also gone up on the short end. So what does that mean to the yield curve in the future? So when I say this, when I think about the profitability of banks, these are 2 of the catalysts when I think 5 years out that are going to be really important to understand in the banking industry. The other thing that's hurt banks is regulations. In the last election, you got people like Elizabeth Warren, you got people like Bernie Sanders talking about the evil banks out there. But here's the thing. Banks are 1/6 of the global economy, right? And they are the oil that runs the machine. Like if cash is not being lent, then businesses will eventually shut down. And as much as we malign the banks, they are necessary to the functioning of the economies of the world, particularly for trade, etc. So here's the thing. One of the problems with banks is the regulators post-crisis have put all of these restrictions on banks on what they can do, and they put a lot of capital requirements that they can't lend out, which is also hurting their profitability. So the additional capital requirements and the restrictions on banking activities have actually also hurt banking profitability and lowered their returns. So when we think structurally, regardless of who I'm talking about banks, if we don't see a change in the regulatory environment, if we don't see a change in the interest rate environment, if we don't see a change in the term structure of interest rates, then we're not going to see a change in banks' profitability overall. And what McKinsey is saying is going forward, they're not expecting any of that to happen dramatically in the next few years. Therefore, banks are going to continue to have negative spreads and they're not going to create value. They're going to be close to 0. Now, here's another thing that you need to know about banks. And I'll just use 3 regions of the world to give you a quick example. Again, this was the 2015 survey, so it's data from 2007 to 2014, but it explains a lot about what's going on. The North American banking market in 2007 was $1.1 billion in revenue. In 2014, it was $1.1 billion in revenue. Over 7 years, didn't change. So the size of the pie did not change, right? In the US, during this period of time, we had consolidations. So there's basically 4 banks that are approximately 80% of the banking market. It's basically Bank of America, Citi, JP Morgan Chase, Wells Fargo, particularly retail. That's 80% of retail banking in the US now. So we have 4 banks in a market that was flat, right? If you want to know why Europe is far worse, Europe went from 898 million, call it 900, to 717. So Europe lost 20% of the pie. And the number of banks in Europe has not changed. And every country in Europe has its own bank because the governments want to have their own banks in their countries. And there's a lot of banks in those countries. So there's a lot more competition for 80% of what the market used to be in this terrible environment. So if you really want to understand why Europe is much worse than the US, this explains it. And by the way, China. Why has China been relatively immune from the banking crisis? Because in the middle of the crisis, they went from 181 million in revenue to 677 million in revenue. The market more than tripled. So in China, basically you could be an order taker and you would make money because basically the market was growing so fast, even in the middle of the global recession. So essentially, you're going to see not just banking, but depending on where you are in the world, your world's going to look completely different, and the catalysts are going to be different. Okay, and so here's how this affects data from today. So let me just escape here. So let's go to Bloomberg, and let's look up a couple things. First, let's look up Deutsche Bank. So here's Deutsche Bank, and I'll do Germany. And let's go to RV, and let's go to custom. And let's create a custom template. As I said, what matters is ROE, so specifically future ROE. So I'm going to type in ROE, and what I want is I want the best ROE for, I'll use the best ROE for next year. So I use best ROE for next year and current year, mean. So for 2016, this is the expectation of ROE of those banks. For 2017, this is next year's ROE. This is the cost of equity. So we get a spread. And this is the expected growth rate, which we had done as a custom formula earlier this semester, the expected growth rate for next year's sales. And this is the price to book multiple, which is the long-term spread of the bank, current one. And I'm going to save this as a template. All right, so here's the point. European banks have a negative spread. 10.78% cost of equity, 6 and 7% return on equity the next 2 years. And price to book long-term 0.82. So the price to book long-term 0.82 tells me they're expected to have a negative spread long-term, and they have a negative spread the next 2 years. And I gave you the context as to why. Because basically the European market has shrunk by 20%. And next year is expected to grow another negative 35%. Right? Europe is in collapse. So if you read stories about why Deutsche Bank is having so much trouble, well, there you go. Right? Because no matter who you are, you're struggling if you're in Europe. Right? Because of the nature of the EIC. And unless there's a catalyst that changes things in the next few years in terms of Europe particularly has some of the worst and lowest interest rates in the world. Many countries have negative interest rates. Banks aren't making money in that environment. Demand is low. Regulation is very high. There's not a lot of banks that are going to be going away. You don't see super consolidation across all the countries. And there's no catalyst that's going to change this. So when I say that the 5-year forecast for banks in Europe is going to be tough, that's my context for why the price to book is 0.82. And that's the point. I don't just want to say it's a 0.82. I want to give a why that it's a 0.82. I don't want to say they're trading at a discount. I want to give a why they're trading at a discount. So I know this took more than 15 minutes to get to this point, and you only have 15 total minutes to do your presentation. You got to be much more concise. But I want to know more about whys for your industry and your company that are affecting your ability to make returns and then competitive advantage. Deutsche Bank is even worse off because they're making negative 2% and 2% and price to book of 0.32. And part of what's actually even worse for Deutsche Bank is the settlement with the U.S. mortgage market. I think they paid $14 billion worth of fines. So it got even worse for Deutsche. Right? They're one of the most troubled banks in the world. Now, I don't think the German government's going to let them go under, so there's probably going to be a bailout of Deutsche Bank. But flipping it around, Deutsche is going to struggle for the next few years, and they lack competitive advantage compared to some of the other banks. So if Deutsche is my bank, then I got to explain why are they doing even worse in this environment than their peers. Okay? Now, how would this be different if I looked at, and let's just pick Bank of America, BAC. Well, here's the U.S. Next 2 years, 9.6 and 9.8 against a 10.7 cost of equity. So Europe is really bad. U.S. spreads are still negative, but they're closer to 10% return on equity. And eventually the price to book of 1.33, which suggests that the price to books are eventually going to say that the market is going to have a positive spread. So where the market is very pessimistic on Europe, price to books are below 1, price to books are above 1 in the U.S., which says that they actually do think the market is going to get better for the U.S. longer term. Right? Now, not every bank is in that case. If I look at Bank of America is still shrinking, and Bank of America has a very negative spread, and their price to book is 0.85, so they're not expected to ever get a positive spread. So they are a really struggling bank compared to the other banks in the market. Right? By the way, if I were to look at, let's look at Bank of China. Oh, where are they? Bank of China, here they are. 60198 basically what you see is the Chinese banks have a 14% return on equity falling to 13%. So Chinese banks are still earning much higher returns because of all that growth they've had. But what's interesting is the price to books have fallen below 1. So 2 things are behind this. Number 1, growth in China is starting to slow in the banking industry. They're not going to triple in size over the next 10 years like they did in the previous 10 years. So a lot of banks sprung up in China just because the system was getting started and everybody was doing well. Now that growth is slowing, it's a much more competitive marketplace, and there's probably going to be some consolidations, and not all these banks are going to do nearly as well because China's quickly becoming overbanked. And here's the other thing. There's a lot of potential bad real estate in China, and people have a lot of anxiety. I mean, China, I've been there, and it's just scary to see all these brand new buildings that are empty. And you wonder, like, who's going to be in them? They built a lot of $300,000-$400,000 houses that nobody can afford. So they planned entire cities that are empty. And somebody's going to eventually have to pay these loans. So all I'm saying is there's a lot of anxiety over some real estate loan losses that these banks could suffer in China. Now, the banks are going to be bailed out by the central government. They're not going away, but that's the other issue. If they start bailing them all out and they don't consolidate and don't fail, then you got banks that start looking more like Europe. So there's a fear that the Chinese banks are really going to suffer. Price to book says that spreads could go negative if this actually is a worst case scenario. Right now, they're still doing better, though, because of that growth at market. But again, that's a different 5 forces in China than a U.S. bank, than a European bank. And so even within the context of your groups, some of you have different regions which could have different forces, and that's okay, but I want to give some additional context. Now, continuing on. McKinsey also in their survey historical period into 3 points of time. They looked at pre-crisis, so 2002 to 2007, and the average big bank around the world had a return on equity of about 14% and a growth rate of about 17%. And the average price to book was 2.2. That was the glory days of banking, right? We're earning great spreads, we're growing fast, and we're worth a lot. But then the financial crisis hit, and what you see is return on equities plummeted to 7, therefore negative spreads, and growth slowed to 4%. That's globally, by the way. And in the developed world, like US and Europe, went to price to books of 1, and Asia stayed at 1.7. Part of the reason why Asia was immune is like China, Asia was growing while US was flat and Europe was shrinking. That's why the price to books were better and the returns on equities were better. What's interesting is post-crisis, the return on equity hasn't gone to pre-crisis level for reasons that I just told you about. Long term, we're still struggling with low interest rate environment, relatively flat yield curves, and a lot of regulation, and not a lot of global growth. And what's now happening is even the Asian price to books are coming down because people are worried about whether or not China's going to grow at the same rate, whether there's a lot of bad real estate, and whether there's too much competition for the slowing growth market. And we already saw what happened to the US and Europe. It's not that they're going to do poorly, but they're going to do a lot less well. And so even the price to books in the developing world and emerging world haven't recovered to what they were pre-crisis. So no catalyst for the next few years, right? The other challenge the banks have, weird. The other challenge the banks have is disruption. And disruption is becoming a real problem, and particularly technology disruption to the banks. But what McKinsey also did is they said, okay, let's look at activities at a bank that require a balance sheet, and that's the items on the left, so lending, deposits, etc., traditional banking activities. And when banks do that, they make a 6% return on equity. Then let's look at other activities that don't require a balance sheet, think payments, that makes 22%. So what they also said is, even if you look at the banks, most of banking is becoming like a utility. It's becoming commoditized. And they're not making any money on lending anymore. It's the other services that they're making money. But here's the point. Does everybody here know what Venmo is? It's now a verb, right? I FedEx something, I Venmo you the money, right? But here's the point. That's not a bank. That's PayPal. And this is the problem. This is where disruption's coming into play. Because when we think about substitutes to banks that is hurting their business, it's the non-bank substitutes. And if you're a technology firm, right? So it's called Fintech, right? Financial technologies. These are startups. They were very hot until a couple months ago. But nonetheless, the fintechs are basically saying, all right, I'm going to use technology to disrupt banking. But I'm not going in after traditional banking services. They make 6%. I'm going where the money is going to be made. I'm going after payments. I'm going after wealth management. I'm going where that 22% return on equity could be earned, and I'm using it with my technology advantage to reach those customers. And that's becoming an increasing problem for the banks. So I don't know if I gave you the stat earlier, but I heard an interesting statistic from a guy at Ericsson that these are rough numbers, but Comcast makes a little over $50 a month per customer on its ISP. So if you have high-speed internet from Comcast, you're paying about $50 a month. Google makes $55 a month off those same customers. Think about that. Comcast puts billions of dollars in the ground for fiber and coaxial cable, regulated monopoly to provide you service, and they make less money than Google with no investment selling you ads and search. I'd rather be Google than Comcast. This is what's happening to the banks because the fintechs are coming in and they're riding the bank's architecture. When you're Venmoing, the bank is actually making the transaction and they're getting nothing. But nonetheless, the money's eventually going to go to PayPal. And PayPal's the one that's going to get the other services and ads that come out of this, and they're just relying on the bank network. See, that's the challenge that banks face. So when we think about power of substitutes and the increased rivalry from these substitutes and how it's going to hurt the industry, this is what's on investors' minds if I'm thinking about investing in the banking industry. So again, when I go back to 5 forces, I need to be explaining this rather than just saying, I think rivalry is going to get higher, the substitute power is going to be lower. I want to give you more context. So this is what I expect next Monday. All right. So continuing on. McKinsey then put in place a threat matrix. And they said, here is where we actually see where the threats to banks are highest in the short term. And they're what we just talked about. It's consumer finance, it's SME, which is small business lending, small and medium enterprises. It's wealth management, it's asset management. All right, a lot of it is retail. So here's why. Citi put out a report, which McKinsey also has a similar report, but I'm showing you a Citi report, that looked at disruption in 4 industries over a 10-year period of time, and they found a very interesting similarity. So they looked at music and how iTunes and to some degree companies like Spotify have disrupted traditional buying CDs. They looked at how Netflix has disrupted through online streaming video, traditional DVD purchases, and rental companies. Remember that Netflix actually used to do DVDs by mail, right? Then newspapers, people don't get paper newspapers and advertising in them anymore, and travel agencies. Do you know that 15 years ago, you could actually walk to a travel agent, they would help you plan your trip out and give you a paper ticket 3 weeks in advance? That was actually that used to be a thing, right? It's not anymore, right? But that's the point. Travel agencies completely disrupted by Expedia, Orbitz, cheaptickets.com. And by the way, one company owns like 16 of the top 18 online travel agency sites. So what you're actually doing when you go from like cheaptickets.com to Expedia.com to Orbitz.com, it's actually the same company, same database, just rebranded multiple times. So I say that because this industry, all interesting patterns over a 10-year period of time, these industries lost around 45% of their revenue. And it was 5 years was the tipping point. Now here's the thing. Banks are predicted to be on the same trajectory. And we're several years into this. And they're expecting 40 to 45% decline in revenue for banks following this similar trend. Why is that important? Reason number one. Despite the fact that these industries lost 45% of the revenue, the disruptors became some of the most valuable companies on the planet. So if you look at music, it's Apple, it's increasingly Google, YouTube, Red, that is turning into very high value companies. They're the winners and they're winning big at the expense of the traditional record labels and the distribution companies. If you're looking at Netflix, they have made all the money at the behest of the studios and Amazon Prime, which is going into video, and other companies. So what I'm telling you is there's big winners despite the disruptions in the marketplace. So you tell me, and I'll pick TD Bank, that's our case study today, that TD Bank is the company that you're pitching to me. Is TD Bank a buy, sell, or hold? And is TD Bank going to be a winner or loser by 2025? Knowing that this market is going to be disrupted, so when you think about the C section, the company section, where are they going to fall? Are they going to fall on the part that lost? Or are they going to be part of the winners? And what are they doing when you tell me buy, right? Or when you tell me sell, in TD Bank's case. Now, a couple more pieces of data. Citi, following the same research report, expects 45% less branches in 2025 than we have today. Actually, this year, we're down 3% in branches nationwide already in 2016. So here's the point. I live in Columbia, Maryland. There's drive-thrus for Bank of America. They closed them all. They're now just parking lots to go into the bank, right? They did it because nobody's showing up, right? It's not that they wanted to close it for convenience. It's that nobody's coming to the drive-thru anymore because we're all doing online banking and banking through our phones. You don't need to go to a bank to deposit checks or even withdraw money anymore. So that's the problem, is that banks are going to lose 45% of their branches. And oh, by the way, they're expected to lose 40% of their employees by 2025. There's 2.93 million people that work in banking today in the US. That number is expected to drop to 1.8 million within the next 10 years. So all of you that are about to go work for banks, congratulations, right? You're in an industry where you're going to make money for a couple of years until they don't need you, and then they're going to get rid of you, right? Because here's the problem. I don't need people to do customer service and back office automation because that's going to be automated by algorithms and computers. So those people are going to be gone. What I need is I need quants to write the algorithms. I need IT people to program the stuff that you used to do manually because I don't need you anymore. I don't need traders. Computers are going to be trading. So I need traders until I don't, right? And that's one of the challenges of banks. Small, big disruption, right? So I tell you this because I'm a Wharton grad. I go to Wharton at least 3 times a month. I know the MBA's at Wharton, and this year, Wharton's one of the biggest feeder schools in the world. That's where the banks go to hire people. They want the Wharton MBAs to go work at Wall Street. Problem is the Wharton MBAs have figured out this out, and they don't want to go to work at Wall Street anymore. They want to go work for Google. They want to go work for Square. They want to go work for Stripe. That's who they want to work for. They don't want to work for JP Morgan Chase because they know that in 2 years, JP Morgan Chase is going to get rid of them. And the hours are going down, the bonuses are coming down, the pay is going down because the government is railing against the banks because they're doing their best to kill the banking system. So here's the thing. You're a programmer. These people need programmers. Do you want to work for Google? Do you want to work for Facebook? Or do you want to work for TD Bank? So that's the next problem. Banks are having trouble attracting the talent because even the engineers that they need don't want to work for them. They'd rather go work in Silicon Valley. So this is a real challenge, and Europe is actually going to be even worse than the US in loss of employment in the industry. Disruption. There's going to be winners in this. There's going to be losers in this. There's going to be a few banks that figure this out. There's going to be a lot of banks that don't. So when you tell me buy or sell, is your bank a winner or loser and why? Or are they just biding time before the tide sweeps them out to sea as well? That's what I want you to do next week that you didn't do last week, and give me some data to support that as part of your 15 minutes. Not the entire, right, but just part of that to give me a better flavor for what you think is going to happen with the companies, right? Because here's another thing Citi did where they looked at positioning your banks. And they did two axes. And they talked about what they called capital intense on one axis to capital light. Capital intense requires a balance sheet, pretty highly regulated. Capital light doesn't require a balance sheet, lightly regulated. I want deposits, highly regulated. I want to do Venmo payments, peer-to-peer payments, lightly regulated. Doesn't require a balance sheet. Versus stuff that you don't pay any money for, cheaper, versus stuff that can be differentiated and eventually get them more fees and or more part of your life. So here's the point. This is where fintechs have been doing well. Right? Capital light. What does it involve? Credit scoring, payments, point of sale, acceptance. I bought a car over the weekend. Here's what's interesting. I wasn't planning on buying a car. I let the emotion usurp my financial stuff because I was like, I'm not going to buy a car, I'm just going to do the numbers. And I walked home with a car. And it was even worse. I walked home with the car. I got to the dealership at 5:30 on Saturday night. I was driving up from South Carolina. I was at my mom's, and I test drove the car. I filled out the credit app, and I actually had the car keys with a credit loan approved for a very high-priced car by 7 p.m. that night. And I drove it home at 8:30. So they took the credit app, approved my loan, took my payment, and I didn't have a check. And they're like, no problem, we'll take your credit card. And here's how they did the credit card. They said, what's your email address? And I gave my email address, and then an email popped up on my iPhone. And I clicked on the email, and then it basically said, type in the credit card number, the expiration date, and the 3-digit ID. This is the amount we want to charge. Are you okay with that? Done. Boom. Got put in my card. Why do you think they did that? And by the way, that was kind of cool. But why do you think they did that? Yeah.
Because they want to separate. It's like further separating you from the concept of spending money.
Now I'm talking about why did they use the phone to do the, as opposed to a swipey terminal?
Oh, because I mean, there's probably less room for like fraud or someone to get your information from that.
Absolutely. And, yes, and the fees are much lower because they didn't go through a bank. They're going through a different payment processor, Fintech, which is actually much lower cost. So I say this because it's actually disrupting the banks, and I'm seeing it in the real world. Same thing. How did they lend me money without really verifying anything? I mean, I literally filled out a half-page credit app. Name, address, income, rent or mortgage payment, previous address, sign here. That was literally it for a very high-value car, high-dollar car payment. That's all they did, and I got approved. And I made my down payment, tax, title, and tag. On Saturday night, when no bank is open, how could they approve that quickly without any underwriting? Because they did underwriting. Why did they need to do underwriting in a traditional sense? Let me ask you this. Do you rent? All right. If you apply for a loan, do I need to ask does anyone here actually own a house? All right. Let's say you own a house. Rent or own a house. Would I know if you rent or own a house without you telling me? Yes, I would. Because when you give me your social security number and credit app, then it'll be on your credit report because it's already in your credit report. And as a matter of fact, I know what your payments are every month, so I don't need to ask you. Matter of fact, you're going to probably tell me a mistake or lie to me, so I'm going to check it anyways. So why even ask you in the first place? Same thing. Are you employed? Yeah. Right? Well, first, you're not going to get a loan for not being employed. But if you were employed, I'd see that in the database too. Right? Do you have a credit card? Do you have a balance on that credit card? I don't need to ask you that because it's on your credit report. So that's the point. What the companies have realized is what fintechs are doing is that I actually don't need for you to fill out all the information because the data is already there. And this is, I can validate it electronically. And as long as I can validate it electronically, I can improve you with an algorithm, right? Because that's the point. If I have to kick it out, I can kick out the exception. I won't immediately approve the loan, but that is being disruptive. And here's an example of this in online lending. I was talking about a company earlier called Lending Club. Show this to you guys. Now they've committed some fraud, so their CEO is fired. You got to be very careful about this. But the concept is still applying, and it's the Uber of lending. You guys familiar with Lending Club? So I work with banks, as I said. So I actually decided to try this out to see if it worked as some competitive intelligence for the banks. So here's the deal. You go to this. It used to be $35,000. Now it's $40,000. So I want $40,000. I want to do debt consolidation. I have good credit. Check your rate. This is the entire application. That's it. Same reason. Because the people that came to do Lending Club came from expertise in credit scoring and the credit rating agencies and the bank backends. And they built the algorithms that basically could score you, and they just check all the databases with the data against your data. And if you meet the criteria, you get approved. Because they don't need to ask you for it. So it's pretty much, what's your rent, what's your income, that's it. They check everything else. So I wanted to see if this actually worked. So I did this at 10 a.m. on a Sunday, sitting at home on my couch. I filled this form out for $35,000. I got a rate. Now, when you hit check your rate, it actually does a soft pull against your credit, which means it doesn't even hit your credit report because they can basically get a credit report without actually doing a credit report. And then if you say yes, then they run your actual credit report. But nonetheless, they gave me 6.99% APR, 1% origination fee, 36-month loan, unsecured. Do you want it? I said yes. The loan was approved in about 5 seconds. Then, do you agree to those terms? Sign electronically. What's your routing number? What's your account number? $35,000 minus a $350 fee was in my account Tuesday morning. That was it. That's all I did. No prepayment. 7% APR for an unsecured loan. Now it's $40,000. And here's the point. They didn't take any risk on this transaction. Because you know who bought my loan? These people. They're just Uber. They match me with investors and they put me into a marketplace. This is the marketplace today. These are actual loans that you can invest in. So here is somebody that wants $16,000 for loan refinancing, 11.49%. They're a B credit. This would be their monthly payment. They've been employed for 2 years. They have a 35% debt to income ratio. It's a joint account with 18% with their spouse. This is their income. They make $23.33 a month with their spouse, $6,083, joint filed. You can get their FICO score. You can get all the other information when you log in, except for their name and social security number. So you're just like a bank. And then they give it to individuals to invest. Now, what they did, which was I think kind of innovative, is they do micro-securitization. So they take the loan and they break it into $25 increments. So you invest $25 at a time. So here's the thing. As an individual, I can put $1,000 and I can basically put it into 40 loans and get my own diversified portfolio, lending across the credit spectrum. And what Lending Club does is they just sit in the middle. They take 1% of the transactions and they just move the money back and forth. Uber to banks. Yeah.
So, I mean, this seems pretty similar to what the mortgage market was before the.
It's exactly what the mortgage market was. And this is where Lending Club got into trouble because here's where I was going with this. Then I work with Banco Santander, known as Santander here in the U.S., big red bank. Santander went in here and they said, you know what? They're doing a better job at sourcing loans than we are, so we're just going to wholesale. So the reason why mine was actually purchased in 3 seconds is Santander bought it. And so the banks are literally buying the loans wholesale that meet the criteria that the algorithm set. And then the ones that don't get kicked out and they go to the regular marketplace that you can invest in, but the banks are skimming off the cream of the crop. And then Santander is taking those loans and they're selling them to Citi, and Citi's packaging them in a CLO and selling it to the marketplace. And then they're using the money to repeat. It's just mortgage being applied to small business and individual retail lending. And so here's the point. Lending Club got in trouble because they played the same games the mortgage companies did, and they started putting in bad loans into good mortgage portfolios, and then they got caught doing it. And it's put a big pall on the marketplace short term. But that doesn't mean long term that this is not a threat to banks. And the real problem for banks is not Lending Club, it's Marcus. They need to fear Marcus. Are you guys familiar with Marcus?
So it's like with this new fintech platform that Goldman is building. It's like an algorithm that prices more loans of any type, and you can like build all sorts of like crazy terms into it. Like they only want to pay every third Thursday of every second month, and then it goes through like an algorithm and it gives you like a dynamic price for that loan.
Yep, but it's even more simple in the way they're starting it. Marcus is also the brand name for Goldman Sachs Online Bank. So for $100, you can actually be a Goldman Sachs customer and you can put it on deposit. So if you think it'd be cool to be a Goldman Sachs customer, sign up right now, all right? And they're doing Lending Club-like lending. They're starting out with the same $40,000, and you can get the loan, and they're basically selling it to their rich clientele to say you can invest in these loans, all right? Here's the appeal. Assuming that there's no fraud, and this is the Goldman brand, that if you can see this here in statistics, I'll use Lending Club as a proxy, this is the stats on the loans of the $22.7 billion worth of loans Lending Club has done. But that's the stat by lending grade of what you're actually earning net of fees and charge-offs. And the answer is close to 8%. And you just don't get that anywhere today for lending as an individual putting your money into the debt markets. And this is what's attracted people like Goldman to do this. Because Goldman, and here's the key, is using Marcus as the beta test. Because Goldman's market isn't the $40,000 retail customer long term, it's the SME, small business customer. And here's why. $50 million is a very important number because $50 million is the minimum required to issue a bond. So if you need to borrow less than $50 million, you can't tap the bond market. This is where banks make all their money because you're strapped to only going to a bank and they can charge you lots of money for that lending market. This is what Goldman's going after because they're going to add a couple more zeros to that $40,000 loan, and then they're going to go to the SME market and they're going to match that with Goldman Sachs client list, and they're going to be the broker in between. So this is the stepping stone to get them there. So I say this because when you think about substitution for banks, when you think about rivalry for banks, when you think about long-term return on equity for banks, the other catalyst is how technology is going to disrupt them and how it's going to really hurt these banks on a go-forward basis. So back to TD Bank. If that's the bank I'm pitching to you in my buy, sell, hold opinion, what does this mean to them? How are they going to do in this environment? So don't just tell me they're a buy because they're earning 12% today. Tell me what this is going to mean to them as part of your 5 forces and whether they're going to be a winner or a loser in this environment and whether they're going to be disrupted or be one of the disruptors. So this is what matters. By the way, for TD Bank, just to put that into perspective, let's go back here. Toronto Dominion of Canada. RV, custom, banks, they're actually earning 14% return on equity the next 2 years against a 12% cost of equity and have the highest price to book almost in Canada because, and you can see this on market cap, basically in Canada, switch this to country of domicile. It's really 2 big banks that dominate Canada. It's TD and it's Royal Bank of Canada. But there's just not a lot of banks in Canada. So here's what makes their market a little bit better is that there's just not as much competition. So TD Bank is not immune to some of the other challenges of North American banks, except that they're in Canada and there's not nearly as many banks in Canada, and regulation makes it hard to come into Canada as a non-Canadian bank. So in a way, TD Bank is going to be disrupted, but it's going to take a lot longer, and they're better for it. Now here's the other thing I know about TD Bank. I was at their innovation center earlier this year. It's right outside of Cherry Hill, New Jersey. So TD Bank is spending a lot of money to try and figure out what the bank of the future looks like. And they actually have a test bank in downtown DC. Has anybody been to it? It's a tellerless bank. It's all ATMs, but they're souped up ATMs and they're headless ATMs. So here's the point. What you do is you put your money in, put your card in, and you talk to, if you need to talk to somebody, video. So they have a call center. You don't have a person in the bank you can actually talk to. And the ATMs do a lot more than traditional ATMs. So they're actually trying to figure out ways to innovate, to win, as they look at losing 45% of their branches and how they can still serve their customers with technology, and they're on the leading edge. So when the analysts look at TD Bank versus a Bank of America, it says, you know what? Hey, they seem to be ahead of the curve. Bank of America seems to be the dinosaur that's not changing. I like them as a buy, Bank of America as a hold or a sell, because I don't see Bank of America with their 6% changing, because they're not doing the innovations that TD Bank is doing. I'm not saying that I've really thought this through, but nonetheless, I am making some comments that I do know about, but nonetheless, that's why I put TD Bank more in the buy category. Plus, they're in Canada, and they have a better track record with lending than Bank of America does. So that would be part of my C, part of my EIC. All right, some comments that I would be making. Any questions about any of this? All right, so here's our final step for today. Excel. And I'm going to open up a file. And we're going to use the key value driver equation. Hide this. So this goes back to the PowerPoint file. So we've been talking about key value drivers all semester. So in the interest of time, jumping right ahead. This is the key value driver equation. And here's the deal. If I'm calculating an actual price to earnings multiple using banking metrics, which are based on return on equity and net income, I can use the exact same key value drivers formula as we would use in this class. So instead of NOPLAT, I use net income. Instead of WACC, I use cost of equity, because I'm based on equity. Instead of ROIC, I use return on equity. And instead of growth of cash flow, I do growth of net income, the LTG growth rate. And that actually gets me a real PE. So, TD Bank, let's do it real quick. This is the key data. And again, I care more about forward data as we're doing multiples. So let me go to Bloomberg and let me look at their WACC and let me get their cost of equity, not their WACC, because I'm doing return on equity. So right now, 12.2% is the cost. Note to previous classes that are watching this video, I accidentally used 7.9 earlier. It is 12.2. Net income for TD Bank. EEO. 2017, net income adjusted. We want to use adjusted net income to take out one-time and non-cash items. So 9,510,000,000 Canadian dollars. Return on equity for TD Bank in the future. Next 3 years expected to be 13.8, 13.8, 13.7. With zero growth equals NOPLAT times 1 minus G over ROIC divided by WACC minus G. Basically putting in the key value driver formula with its substitutions. That would be their equity value. This would be their PE ratio. And right now, their estimated PE is 12.5. So are they expected to grow? Yes. And so the key here is, here's what I know about TD Bank. They're expected to grow, and they're expected to have a positive spread. That's what the current price to book or price to earnings multiple tells me against what the estimate is. And so when we talked about these disruptions, I could say that the five forces are hurting the banking industry, but TD Bank is in Canada, and the five forces in Canada look a little different than the five forces of the other industry. And for competitive advantage, people think that TD Bank's retail business, which is open 7 days, they're in good markets, they're doing some innovation to drive the disruption retail themselves. They're probably going to be disrupted less and might actually be one of the disruptors because they look like they might be one of the innovation winners, and that's the way they're being priced in the market today. That's why they have a price to book that's higher. That's why they're trading at a higher multiple, and that's why I'm calling them a buy. See the difference between what we've talked about? What I'm expecting for next week? And by the way, this is going to be part of your homework assignment. I will give you more banks or financial services companies, and you will be doing this analysis with or practice five forces, practice competitive advantage, practice industry, practice numbers that go with the multiples that support that to basically answer these questions that we're talking about. Right? By the way, what's the growth rate here? TD Bank's expected to be one of the winners. And by the way, one of the reasons they're winners is they are actually expanding in the U.S. They're taking share away from the Bank of America's, the Wells Fargo's, the JP Morgan Chases. And they're picking the areas of the U.S. that are more attractive. So they're in the coasts, right? They're in, Mid-Atlantic coast. They're in Southeast. They're in Gulf Coast. They're in the areas that are growing, that are highly populated, that are making more money. And they're staying out of areas like Pittsburgh. They don't want to go to areas where they're not making money, that are growing or not growing and shrinking as a market. So they're cherry picking their growth. And they are considered one of the disruptors of the banking industry. So again, just a little bit more context to the EIC. Questions about anything we just did? All right. Wednesday, 10 a.m., make sure you turn in your write-up and Excel file for the financial services company that I'm going to give you, which will be available at 4:30 today. And I don't want to give it to you now just because I do have another class coming in, and I don't want them to do it during class. So basically, it'll be available. You'll need to get this data quickly out of Bloomberg. It won't take you long, but you will need access to a Bloomberg terminal, and you will need to kind of write up a little EIC and potentially a little bit of impact on the multiples, because what I want context, and it's just practice. And we'll talk more about it on Wednesday, but I think this is the same thing I need you to be doing on your group projects. So this week, when you're reworking your group projects for next week's presentation and you're building out more data, so this is the more that I'm looking for. And again, a good source for this information, go to Bloomberg Intelligence, BI, right? Read the analyst reports. Go find a couple analyst reports if you didn't already for your group project. Thomson One on the portal, the UMD portal, has a lot of analyst reports on the companies for free. So go get the analyst reports from Thomson One. Read those. Use that to give you additional context. So I want all the numbers. I don't want you to just repeat the numbers, but when you do your actual presentation next Monday, I want to see the numbers, talk about a couple numbers, and then give me the context, kind of like we were talking about today, when you give me your final buy, sell, hold opinion. Okay? Clear on what we're looking to do? All right. Otherwise, have a great day. We'll talk again on Wednesday.